G'day folks, it's Jim here from Orchard Forex, and it is Saturday the 6th of November. And markets have just finished on a pretty positive note at the end of the week. The non-farm payrolls were released, and they were pretty solid numbers all round, and beat expectations, leading stock markets to end the week. They reached all-time highs. The S&P made it to above 4,700. Finished just below, but it was a positive result at the end of the day. The Dow and the Nasdaq, likewise, they made new all-time highs. So at the start of the coming week, everything looks pretty positive in that direction. Foreign exchange markets were pretty much mixed. The euro remains pretty heavy, but the dollar didn't do a great deal. The dollar index finished a little bit lower, but didn't do an awful lot. Commodities generally had a pretty good session. Gold got back above $1,800 an ounce. Both gold and silver finished up about 1.5%, and oil had a good run. It's back above $80 a barrel, back above $81 a barrel actually, and that came following last week's OPEC meeting. So it was a pretty positive end to the week all round. Looking ahead, the calendar's going to be dominated really by inflation data this week. We've got CPI and PPI numbers coming from most of the major countries, China, the US, Germany, the EU, Japan, Australia. So that's what's going to direct markets, I think, this week. The earnings season is more or less done now. It will be a holiday on Thursday, so the week's going to be a little bit cut up. It's going to be Veterans Day, Remembrance Day on Thursday, and that'll probably turn into a long weekend. So it could be a fairly quiet end to the week. But in the meantime, we'll go and have a look at charts and see what they've got to say to us.
Okay, folks, so we'll start with a weekly chart of the dollar index, and the consolidation that we've been going through for several weeks now, probably over a month, seems set to continue. The weekly indicators are very mildly positive, and we may push higher yet, but we're sitting right on this 100 weekly moving average. And below the 200-week moving average, which comes in at 94.80 or so. And I don't think we're going to go very far from there this week. As I say, it's a holiday on Thursday in the States, and it wouldn't surprise me to see this 94 level remain a bit of a fulcrum at the moment, and I'd probably be looking to trade a range of sort of 93.80 to sort of 94.50. If we come back to the daily charts, you can see this consolidation phase. Really, we've been, since breaking above this neckline here at the end of September, we've really done very little at all, and the foreign exchange markets really aren't the place to be in at the moment. It's really all about stocks and commodities. But the daily indicators not telling us a great deal, and as I say, I think 94, the figure, is probably going to remain a bit of a magnet. The neckline here, 93.5, I don't think we're going down there, but if we do 93, the figure, that's the 100-day moving average. And as I say, on the weekly charts, we've got 94.80 or so, which is way up here as resistance, and I don't think we're going there. One interesting thing to look at is if we just go forward to the bond market, and here we have a daily chart of the 10-year bond. Now, as you can see, yields went quite sharply higher over the last couple of weeks while the inflation headlines were coming through. But since then, really, we got up to what, 1.7 on the 1.7%, that is, on the 10 yield. We're now back at 1.45. So I think that's going to stop any real further dollar strength at the moment. And the daily indicators suggest that we're probably going to push to the downside with a 100-day moving average is down around 1.4%. So if that's the case, I see pretty little upside potential for the dollar. Having said that, the ECB is also pretty dovish about the outlook for the EU, and that makes me think that really with both central banks not wanting to commit too much either way on their interest rate outlook from their current policy settings, I think we're probably in for more choppy trade. So that's the outlook on the dollar index and the bond market. We'll go and have a look at the euro. Okay, so we'll start off with a daily chart of the euro, and as you can see, we actually did make a new multi-month low here, reaching levels last seen in July 2020. So that was fairly significant. This 115.20 level has been support. We briefly took that out, but we closed back up at 115 and 60, 65. We'll come back to a 4-hour chart. So as you can see, we did see this spike down, but this support level bought in buyers, and we've closed a little bit higher. Now, the 4-hour charts really aren't telling us a great deal, and that's why I think we're probably likely to stay choppy on Monday. The dailies equally not telling us a lot, and the weeklies, we're sitting right on this 100 and 200 week moving average. So I suspect that we're probably likely to do much the same for the coming week. If anything, the weekly charts are showing us a minor negative bias for the euro, but there's plenty of support on the downside. I think this 115 figure to 115.20 level is going to be strong. If we go through there, there's probably not an awful lot. If we come back to the dailies, there's probably not an awful lot. We get this down here, 114.90, but then as you can see, there's, you know, it's going to get pretty messy in around this area. We might work our way towards 114, but I think it's going to be a slow process if we do so. And really, quite now, I think there are better things to trade. Dollar yen, as you can see, is looking pretty choppy. The dollar fell at the end of the week, and that's probably largely in relation to lower US bond yields. So the 4-hour charts actually do look a little bit negative. And it wouldn't surprise me to see the dollar yen come under a little bit of pressure. Obviously, there's going to be reasonable support around here, just above 113 at this kind of level here, 113.20. But if we go through there, I guess there's probably not an awful lot really, but for quite a long way down. But I don't really think we're like to see any major move lower in dollar yen. If we do head lower, I think it's going to be pretty choppy. The daily charts, once again, as you can see, there's actually not an awful lot of support to sort of 112. So we could see a movement in that direction. The daily indicators are pointing lower, so I'd rather be short dollar yen than long. And if I was looking to sell it, I'd probably look to sell a rally from current levels, but with a tight stop loss back above 114, which I don't think we're really going to get there. But that's the way I'll be playing it at the moment. Sterling. Sterling took a decent hit last week after the Bank of England failed to hike rates as everyone thought they would, and it's been down to what, 134.25 or so. Finished at 130, just below 135. Actually, on the hourly charts, you can see that we might be building a reverse head and shoulders. We need a bit of work to do on the second shoulder if that's going to be the case. But from sort of 134.20 to sort of 135, that's 80 points. That would take us up to around this 38.2 level, 135.75 or so. May not work out that way, but certainly the hourly indicators are suggesting we could move a little bit higher. The 4-hour charts, the indicators there seem to be basing out to turn a little bit higher as well. So if anything, I'd rather buy dips down to sort of 134.5 in sterling, looking for a move above 135 and possibly onto that sort of 135.50, 75 level, something like that. The Aussie, okay, here we are with a 4-hour chart of the Aussie. The Aussie's had a tough few days really, and got down to levels last seen sort of mid-October. 73.58 I think was the low. We've actually managed to close back a little bit higher, around 74 cents. And the 4-hour charts may be showing a bit of a base to start the week. If we come back to the hourly charts, let me blow that up a little bit. We're sitting just below some resistance here, 74 and change. If we can head a little bit higher, 74.30 I guess will be a level to look to possibly sell it. The daily charts hint that we have got lower levels ahead of us eventually. So as I say, if we saw those rally to 74.30, 35, probably look to sell into that. For the time being, though, we've got the 100-day moving average, the blue line here. That's acting as support down around sort of 73 and 3/4. But if we can take that out, then I suspect we probably are going to see a little bit of a dip lower. A lot depends, I think, on the price of iron ore and coal, both major Australian exports, which have declined quite rapidly over the last few sessions. If we go forward and have a look at the weekly chart, the momentum indicators here are not telling us an awful lot. So as I think as before, I'd probably be looking to buy dips down towards 73 cents if we get there. This 100-week, 200-week moving average, that's not until 72 cents, so that's still some way off. But because I think the FX markets are generally going to remain range bound for the coming week, the Aussie that equally applies. So sort of 73.50, I believe, maybe 73.50 be looking to buy it. But equally 74.50, I'll be looking to sell it early in the week. We have got inflation numbers. I think consumer inflation expectations are out midway during the week, so that could be a major move for the Aussie, but we'll go and have a look at the calendar at the end of the video. The Kiwi, just quickly, as with the Aussie, the Kiwi reached new lows that we haven't really seen since mid-October on Friday following the non-farm payrolls, but it did recover. And now it looks as though it's coming up against the 100 and the 200 hour moving averages in the very short term. But the short term indicators do look positive, and so a test of this level, where's this sort of 71.50, wouldn't really surprise me. We might even be taking out a bull flag, and that may even see a run up to sort of 71 3/4. If so, I'll be looking to sell it there. We've moved forward to the 4-hour charts. The indicators here, 4-hour indicators, not telling us a lot, but if anything, they're very slightly positive for the start of the week, while the dailies actually look as though they're turning very slightly lower. But we have got good support here. We've got the 200-day moving average down here at 70.80 and the 100-day at sort of 70.25. So I think if we do see downside, progress is probably going to be pretty slow. And once again, as with the Aussie and everything else, I think pick your range and trade that accordingly with the appropriate stops in place. So that's about it for the currencies. I will look at Aussie yen. I looked at Aussie yen last week. I'll look at it again today. Okay, so last week we were looking to sell Aussie yen, and it turned out to be the right move. And I think with the 4-hour charts pointing lower, the dailies also pointing lower, I think that remains to be the case. If anything, I think the move will come via dollar yen, because I think if bond yields do head lower, as we saw a little bit earlier, if bond yields do head down, I think dollar yen will head down, so we'll see yen strength, and I think that'll drag the cross a little bit lower. So if we come back to the 4-hour charts, we've broken through the first Fibo level, and we're now looking at sort of 83. Well, 83.50 was my first target, but I'm really thinking now we might get down to 83 itself. At which point I might still think of being buying it, but it's too early to work that one out yet. If we go forward to the weekly charts, you can see that the MACDs still look very mildly positive. So I'm a bit cautious about being too short at the wrong levels in dollar yen. But right now I still think it is a sell. And if we come back to the 4-hour chart here, I think if we got back to 84.50, 84.25, somewhere around there, that's the level to sell it. With a stop loss probably above sort of 85, I guess, something like that. I don't think we're going back there for the time being. And if anything, I think this 38.2% retrace level is likely to come under pressure at some stage during the week. Okay, that's enough on the currencies. Commodities and stocks. And here we have a daily chart of the S&P 500, which once again every week it seems to be it's at new all-time highs. The indicators are still pointing higher, and they don't look as though they're turning down. The stochastics may be telling us we need a little bit of a correction, and the RSIs are definitely becoming overbought. So we need to be a little bit careful. If we come back home to the 4-hour charts, I'll wind that up a bit. As you can see, we've been above 4,700 now for the first time, closed back just below it. The 4-hour charts might be telling us we need a bit of a rest Monday, Tuesday, but and the RSIs equally, and the stochastics, they're pointing a little bit lower. So maybe we don't take out this level early in the week. We have got the US inflation numbers coming out. I think it's on Wednesday, so that will be the main driver this week, I think. But at the end of the day, the mantra remains that don't fight the trend. The weekly charts, which had been turning lower back here, the indicators now seem to be turning higher. So eventually, I think we've got the run into Christmas to come now. The Santa Claus rally, it would not surprise me in the least if that continues to happen. And above 47.17, which was the high on Friday, I wouldn't be surprised to see us eventually head on towards 47.50 and 4800, but it's going to be a slow process. The other major indices in the States are really much in the same boat. I won't spend any time on those, but they're all heading in the same direction. They're all slightly overbought, or to varying degrees overbought, but I think you've just got to shut your eyes and go with the flow. But raise your stop loss accordingly, of course. The Aussie market's a bit different, and here we have a 4-hour chart of the ASX 200, a poor old Aussie market's been lagging badly. That's mainly because the iron ore prices collapsed from $240 a tonne to something under $100 a tonne. So we've got some catching up to do here. At the end of the day, though, I'm fairly positive about it and think that if we can take out this sort of 74.80 level, 75 figure 10, that's not too far away. We then got this high up here, sort of 75.60. And hopefully, eventually, we'll actually get back to our own previous all-time high at 76.40. Long, slow process. But the daily indicators, let's wind that up a bit. They're pretty flat. Not telling us a great deal, but there is plenty of room for them to play catch-up. So I actually quite like this market. I think it has got room to go higher. Unfortunately, until the iron ore price does turn around, which may not be for quite a while yet. But I see some of the Australian banks are suggesting the iron ore price is finding a floor here, so that should underpin the market. And a lower Aussie dollar, if the Aussie dollar does continue to head lower, that should help underpin the market as well. So I am looking for a break of 74.80, for a move to 75 figure 10, and then eventually maybe back up to these sort of levels here, sort of 75 3/4, something like that. So that's it for the stock markets. On the commodities, we'll start with gold, and this is a 4-hour chart, and I'm quite enthused by Friday's move in gold. It's been awfully choppy, and it's been quite difficult to stay long, although I'm really quite bullish on gold in the long term. But we had a good finish to the end of the week. This resistance line up here is what 1830, 1835, that's this previous high here, where it's failed on more than one occasion. That's going to be strong resistance. But I eventually think we are going to take it out, and if we do, the next port of call will be around 1860. The 4-hour charts for the start of the week do look positive. Move forward to the dailies, and here you can see better this trend line I was talking about. And let me blow that up a little bit. We've got to take this level out here, but if we can take that out, then the next major FIBO levels up around 1875. And I think there'll be some choppy resistance in this kind of area here, 1850, 1860. But I do think that's the way of it. Gold is not overbought. It's got plenty of leeway to the upside. It may still remain very choppy. We may yet see another test of this sort of 1790 to 1780 level. And we could yet see another one of these nasty downswings. But I'm staying long. And I actually don't think we are going to go back down there now. I think we could see a move towards this 1835 level and then onto higher ground. Silver, and here we start with a daily chart of silver. And like gold, it's been pretty tough to trade. We've been in this very slow, choppy, corrective downtrend, and we had a nasty spike lower last week. But we've come back to 24.20. The 100 days moving average sits in the way for the moment. But I think we're going to take that out. I think we go back to sort of 24.70 and sort of 25 plus. And eventually, I think we're going to test this level here, sort of 26.40 at the moment. So, some way off, and there's going to be plenty of resistance, particularly at this level here, this sort of 24.80 level. But if we can take that out, I'm really quite bullish on the metals. As with gold, the indicators aren't telling us a lot yet, but there's plenty of room for them to play catch up. If we go further out to the weeklies, once again, indicators not telling us an awful lot, perhaps a little bit positive if anything. We've got the 55-week moving average, which ties in with that previous moving average I was just telling you about just here. This is the brown line, 55-week. But once we take that out, I do think there's plenty of room for the upside, and I'd much rather be playing these commodities rather than the FX markets at the moment, because I think there's a lot more leeway to be had out of them. Finally, we'll just have a look at oil. And here we have a daily chart of West Texas Intermediate. Now, that had a decent rally on Friday on the back of OPEC plus disagreeing with Joe Biden. Joe Biden wants OPEC to increase production, and OPEC want to go at their own pace. So increasing demand and shortage of supply saw a decent rally, basically. But the daily indicators still don't look very positive. And I think there's probably better things to trade now than oil. This trend line here, which that had been in place, and it did run quite nicely for a while. We broke that on Thursday. We have come back to test it and sit right on it at the end of the week. For the time being, I think this level up here, this is 85.30. I would think that's probably fairly toppish for the week. In fact, I'd be surprised if we get above sort of 83.5 early in the week. At the same time, this sort of 78 level is probably fairly much a base. So I'd probably trade the range for the time being. As far as the weekly charts go, they are still positive. The MACDs are positive, but the RSIs and the stochastics may be telling us that we've reached a bit of a peak for the time being. Much longer term, I still think we're going higher. I still think we're going to take this level out, this major FIBO level, and eventually I think we're going to $100 a barrel. But that remains a long way off at the moment. And maybe we need to do a bit more work around here in coming weeks above this rising trend line here. That's currently much lower, and right now it's at sort of $71 a barrel. But it's moving higher quite sharply, and maybe we just do some consolidation around here before we see the next leg higher. That would allow the weekly charts and the weekly indicators to unwind, and would allow us, give us extra momentum if and when we do make the next move higher. So anyway, that's about it for now. We'll have a quick look at the calendar and then call it a day. Okay, here's the calendar. So over the weekend we've got the Chinese trade balance, and also US daylight saving time ends, so the calendar will be an hour later, at the end of the New York trading day, that is. So Monday, a very light day indeed, really nothing going on. Tuesday, equally so, there's very little. We've got some numbers coming out of Germany, the trade balance and current account, and the ZEW. But then we've got the first of quite a few inflation readings coming out during the week. We've got the US PPI on Tuesday, and then Wednesday we run straight into the China numbers, Chinese October CPI, and those coming from Germany we get later in the day. And then even later, we've got the US. So that's going to be a fairly hectic session, I think. And that'll probably be the main day of the week as far as any volatility goes. Thursday, as I said, we've got it's Armistice Day, Remembrance Day, Veterans Day in the States. So that'll be fairly quiet. But there'll be a bit of action out of Australia. We've also got PPI inflation numbers coming out of Japan. That'll be early Thursday, but we've got unemployment coming out of Australia. It looks as though we're expecting quite a turnaround in the employment numbers for Australia in October, so that might be supportive of the market if they live up to expectations. We've then got some manufacturing numbers coming out of the UK on Thursday, but because it's a holiday, I would think it's going to be fairly quiet otherwise. Then Friday will probably turn into a long weekend for a lot of traders. So there's not an awful lot on the calendar at all. Some EU industrial production. The Michigan consumer sentiment numbers will be the highlight on Friday, and they'll be important, but market liquidity I think will be fairly thin because of the long weekend. So anyway, that's about it for this week, folks. Have a very good week's trading, and we'll talk to you again next week. Cheers.